So I've bought a stock today, and what is it? As you can see, we've got the fills here and we got some working orders here. The stock is FTCH, so Farfetch. Now, why are we long this stock, and what are these two orders? So this $90 or $25 debit, these are puts as protection. The $2.95 is our average long price, and again, we are sending out some orders to potentially get in some more shares long and start selling some covered calls. So let's go over what we're actually looking at and why I'm long this stock. So we got a massive sell-off last night. This was off their earnings. Again, basically just lower than estimates. And it wasn't looking great. However, the reason I'm long this stock, again, I don't tend to trade technicals all that often off these fundamentals because, again, fundamentals are that key driver. But what I do like to be paying attention to is where are we sitting from a longer term view. And if we zoom out on the 6 month, we are extremely overbought. And on the 1 year, not actually extremely because it's been in such a strong sell-off going from around $13 to $2. So we do definitely need to be a bit more cautious. But again, considering we're extremely oversold on the 6 hours, I think there is a lot less risk to take a stock like this long. But again, on a stock like this, we do need to be prepared. If it's $13 down to $2.70, this is never a stock you want to buy and then end up bag holding because there's always a chance that could happen. So the thing I look to do is protect the downside. And how are we doing that? And again, that's like the fills we talked about. The way I'm trading this is we are long shares and then we are long puts. So again, we're long shares and you saw our average was at $2.98. We then bought $3 puts, which are currently around $21 to $24. The reason we do this is then if the stock goes against us, our max risk is whatever we pay for that premium. Again, considering we bought basically at $3, if it goes below $3, these puts go in the money and they'll buy or they will sell our shares at $3. If it come at expiration, we are trading below that. So again, we're long at basically $3. We then hold these puts long. So what this basically means is if Farfetch goes to $2.75 or below, our risk can basically be no bigger. So $2.75, well, anything below $3 is basically max risk coming into expiration. But if the stock was to go to $2.75 or below, we don't actually lose any more money. That's what this protection does. If we're risking $25 per put that we bought, you know, you're only risking $25 per 100 shares that you've bought. So that's how I'm looking at the downside protection. Now, how am I looking to make more money off this trade? So again, we got this protection. If we don't see that bounce in about 2 weeks, then I'm happy just to call that a loss and get out of that trade. But if we do start to go to the upside, not only will we profit on the shares we are long on, again, obviously that call will lose value. I mean, that put will lose value. So maybe the first 10-20 cents you make on this stock is basically going to offset our protection. So that's something to note. But what we can do is as we go up to the upside, obviously profiting off the shares. But what we can do, and I've sent out some orders, so we'll see if they fill, is looking to sell some 350 calls. And the reason that I'm doing that, and again, we have our order out at $15. So what this will do is you're then turning it into a cover call. So you get paid, if we can sell these at $15, you'll get paid $15 to sell that call. So what that means is if Farfetch goes against us and we're selling that for 15, our max risk is $10 per 100 shares we bought. So not too bad. If it goes our way and stays below 350s, we're up whatever we've made on the shares. And if it goes above 350 coming into expiration, not only do we keep that premium we made, so $15 per call we sold, but we will also profit $50 for each 100 shares that we owned. So that's how I'm looking at trading it. Again, on these kind of stocks, I prefer the protection. Yes, you do sacrifice some profits to do it, but on stocks like this, they can continue to go down. So it's all about being protected, or at least that's how I look at them. So again, we're long the shares at $3. We've got a $3 put to protect us to the downside if it continues to continue downwards and went against us. But we haven't entered this bit yet, but that's going to be selling the 350 calls to enter into a cover call and hopefully profit more to the upside. So again, we'll see how this plays out. This bit we haven't quite yet entered, but we got the orders out. So if we can hit that today or coming into next week, that will be ideal. And quickly, what are some targets that we're paying attention to? So again, if we're long, why am I selling the 350 puts? the 350 calls, and that's because at 346, this is our second deviation over on the 6 month. This can be quite a strong resistance, so if we come into this level, it's not unlikely to see a pullback. And that's why I'm quite happy to sell the call there. That'll be my main target again on stocks like this. I want to be out in and out relatively quickly on a stock that's down, 40%. We're playing a more fundamental play off technical levels. So again, want to kind of be in and out. We're playing off, kind of the closest key levels we can get out in and out relatively quickly. So yeah, that 346 is going to be that key resistance to pay attention to. Again, if we continue to the downside, we got a key level at 260. And again, that's why I like having our max risk no lower than 275, because if it falls down, we hit this level as a support and it bounces, and obviously that should take us back in the money, and we should be targeting that 345. However, if that level does not hold and we continue down, we've got no more risk on the table, so that should keep us protected.